Hi, I'm Rick Kahler. Thanks for joining me. As we get closer to Election Day, the most common question people ask me is, what is the election going to do to my investments? This is usually followed by, if blank is going to be elected president, don't you think I should get out now while I have a chance? And it really doesn't matter whether the blank is filled with Clinton or Trump. Many people think one or the other will mark the death knell of the economy. I've witnessed these same concerns in other presidential elections over my 35 years as an advisor. People are always worried that if the candidate they dislike becomes president, it's going to be devastating for the markets and their portfolio. Are there some precautionary measures that you should take to protect your retirement portfolio from an election day disaster? Well, let me share with you what I am doing in my personal retirement account to prepare for the worst. Nothing. I don't believe that whether Clinton or Trump wins will make any long-term difference to a diversified investment portfolio or the U.S. stock market. There's no past evidence to suggest otherwise. Now, I would expect many investors to disagree with me, but I would expect most investment advisors to agree. But according to an article by Michelle Zhao in Financial Planning on September 13, 2016, entitled "Election Jitters Have Advisors Seeking Liquidity for Retirement Plans," I was surprised, if not shocked, to find this isn't the case. The magazine asked 320 advisors, how will the outcome of the U.S. election impact retirement planning, and what actions are you taking now? I want to emphasize that this question focused on the impact to retirement portfolios, which are inherently long-term in nature. This wasn't a question about how to play the market immediately before or after the election. It focused on the long term. Now, apparently, most advisors believe this election will have a lasting impact on their clients' portfolios. The article quotes one advisor as saying that preparing our clients mentally and taking income stabilizing precautions for our clients in retirement is a priority now. Another said they are building larger cash positions as the equity markets test all-time highs and we have such an uncertainty regarding our future leader. Still, others said they are selling equities, putting more into liquid assets, and halting new investments altogether. Now, I've got to admit, this is fascinating to me. I mean, basically, the average advisor is acting out what the average client is thinking. When things look rocky, let's bail out. Based on what we know how the brain works, there's a high probability this isn't good news for their clients. As an investor who does not have a financial advisor recently told me, isn't the biggest value proposition of having a financial advisor in keeping you in the markets during downturns? Yep. I was just further amazed to read in this article that when advisors were asked how much the election would affect their financial planning practices over the next 12 months, around 6 out of 10 feel it will have a moderate to high impact on their businesses. Seriously. Just 1 out of 10 advisors say this election will have no impact on their firms. From what I read, the question didn't specify whether the impact would be negative or positive, so maybe advisors are expecting positive changes from this election. However, it looks as if most advisors are expecting rough seas for both their businesses and their clients' long-term portfolios, regardless of who wins the election. Given the unprecedented nature of this particular presidential election. It's not surprising that investors' sentiments are more intense than normal. That doesn't mean their fears are any more valid than in other elections. As usual, the best way to election-proof your portfolio is to leave it alone. Thanks for listening.